Now let's expand upon our example and add in financing of the purchase of the car with a loan. The two golden yellow bars indicate the changes that we're going to have in our income and cash flow statements because of these two pieces. Now, the loan that I am creating for the purchase of this car is really simple. All it is that you borrow money in 2010, and in 2011 you make one payment. So the payment's going to have all the principal and interest packed up together in it. And so it's just going to be, you're going to borrow $10,000 and then you're going to pay back $11,000 because the interest rate is 10%. So let's go ahead and show you where the $10,000 comes in, and the place that you are going to see that you took out a loan is down here in the cash flow statement under this new section that we've created called Finance. And that $10,000 right there this is the loan. Now what that means is the loan is going to be a source of cash for you, so it's going to indicate cash that's going in. None of this other stuff changes. I mean, the car is still there as a negative $10,000. There's still cash going out because of it. But you're going to see that because you borrowed money, you have this new source of cash come into it. And that's how you're going to see a loan. That's how you're going to see this finance. Now the other thing that I've added is going to be this interest expense. Now please note, year that you take out this loan, there isn't going to be interest expense. What we're doing is we're moving that all over into the second year. The idea is you borrow $10,000. There's a 10% interest rate on it, and so your payment in the year 2011 is supposed to be $1,100. Now please note, like we discussed before, the payment on the loan gets split into two components. Some of it ends up being an interest expense, and that's just that $1,000 that's right there, and that's what you're seeing, this positive number indicating there's an expense right there. The other part is going to be the principal payment. The principal payment shows up down in the cash flow statement as a negative number because it's cash that's flowing out. But if you just go ahead and add the 1,000 together with this 10,000, please ignore the negative sign, you see that the full $1,100 payment is right there. Now look what happens in the year that we have up here. We've made a couple of different assumptions. First, we're going to say in 2011 that change in operating revenue from the state where we don't have or didn't make the purchase of the car is now 0. So an interpretation of this is that in 2010 we kind of like bought this salesperson a new car. Salesperson got excited. We ended up with $1,000 worth of additional sales. But the next year, the salesperson is not so excited because, it's the same old car that they had last year. And so while sales originally spiked because you purchased this vehicle, they're back down to what it would have been if you hadn't actually purchased this new vehicle. Now, again, this is the interpretation that we're going to have of the numbers, and actually what we'll do is we'll say that that's going to happen in every year thereafter, okay? So all we're seeing is a single year spike in sales, increase because we purchased this vehicle. This does not mean that the level of sales in 2011 is the same as in 2010. What it means is the level of sales in 2000 is back down to what it was if we had not purchased the vehicle. Now our operating expenses are also going to be as low as they were before. They are going to be $1,500 less than what they would have been if we had not purchased the vehicle. So let's be clear on those interpretations. Next element that we have here is this new interest expense. Please note that this is this extra addition. It's an extra expense, and I've added in depreciation of $3,200, which is what you have in the second year you own a 5-year asset. It's just going to be 32% of the cost basis, which is $10,000. Now, taxable income in this second year you own the asset is going to be a negative number because look at what we're doing right here. We're taking our revenue, and that's what E2 is, and we're subtracting off all those other expenses. And so what you're noticing is that your taxable income is actually lower in the second year that you own the asset rather than higher. And so if you have a reduction in this taxable income relative to what it would have been if you had not purchased the vehicle, you're also going to have a reduction in taxes. And that's what that negative number there in the taxes indicates. Negative means that your tax burden has gone down relative to the state where you did not purchase the vehicle. Okay, if it was positive, it would mean that your tax burden has gone up relative to the state where you purchased the vehicle. Now remember, all that we're doing with taxes here is we're just taking that taxable income and we're multiplying it by our tax rate, which is 50%. The space below that is just the net income. And I'm echoing back, as we explained in the other vehicle, the net income is a source of cash, depreciation is a source of cash, But here's the important part. There's this giant sink of cash because we made our loan payment, and that $10,000 that we have right there represents our principal payment. Now, as we've had in the past, that net cash flow is just going to be the sum of all these sinks and sources of cash. So while the first year looks great because we had this loan, the second year is not so hot for us as far as cash.